All right. Okay, so welcome to the Bond Bank's what I hope will be semi-annual webinar on our energy and housing program, as well as other specialty programs that may develop over the coming years. Most people are familiar with us through our pooled loan program, which is our loan program that does just about anything that municipalities and school districts need. But what we wanted to do is highlight this special program because we semi-annually talk to people about our pooled loan program, the application process, how all the mechanics work, but we haven't done so other than at the time of announcement for these other programs. So we just want to regularly get in a cadence to make sure people are aware of them because they are really developed around lowering costs for projects that we know people are in the state are doing anyway. Um, I'm going to keep an eye on the meeting invite here. So, yeah, the long story is that, we've been around a long time. We did we've had the pooled loan program, the SRF work, and then more recently, what we've done is to take our understanding of how to take big, high level sources of capital and make those bite size, have form documents for communities. And really what got us thinking about that was in after the Inflation Reduction Act and energy projects, we went out looking for low cost capital to do energy efficiency projects that we've been financing forever. I mean, we've done wood pellet boiler replacements since the 90s. And so this is nothing new. What is new is that we have a really advantageous cost to capital. And so then that same concept was extended to infrastructure to support housing. That's obviously a big goal of the state. And so we'll go through those two programs during this. So we're going to start with the energy program and kind of go through some of the requirements there and the lack of requirements, and perhaps more importantly, and then we'll get on to the housing program. So the energy program is for energy efficiency improvements as well as renewable energy. The kind of barrier to entry is that you have to show some level of either energy savings and or cost savings. And that has a minimum target of 5%. In a perfect world, all of our projects will achieve 15%, but we're have quite a bit of capacity in this program, so we're definitely willing to work with people as there may be an opportunity. Um, the there's some eligible activities here on the right. To date, the things that we have financed are well, Ken, why don't you just go through that? Ken reviews all these projects very, very closely. So Ken, you just want to go through some of what we've done to date?
Yeah, sure. So it's really been a variety. We our first project was we helped the town of Charlotte finance a solar installation on their town garage. The town garage we financed through the pool loan program, and then they wanted to add the solar installation to it, so we financed that here through this energy efficiency renewable energy program. Um, We've also we helped the town of Chester buy a solar field. So it was an acquisition. Um, and then we've also helped with building envelope improvements for a school. Um, so really, there's been a variety. Right now, we're working on helping a town, we're helping a school do a fuel switch from um, oil to propane and integrate more efficient boilers. Um, and for another town, we help them buy high efficiency HVAC equipment, rooftop air handling units. So we can do a variety of things, and we have been doing a variety of things. I don't know how much more you want me to go into, Michael.
That's perfect. That's perfect. Thank you. So because it is an energy program, we are required to document the level of energy savings. And so there's a number of ways in which we can do that. For the solar projects, we're really relying upon the the capacity of the unit, and the projections provided by the installer for the more efficiency related projects. There's a couple of ways we can do this that we have used to date. One is, if it's a piece of equipment, we have a relationship with Efficiency Vermont where they can do what's called deem savings. And so they sort of look at that piece of equipment as compared to the alternative and deem there to be savings with it. That sort of checks the box on the measurement requirements. To the extent it's a building envelope improvement, for example, where there isn't an energy performance contract, then we are going to ask for things like your energy bill and or gas bill or whatever the case may be, to try and verify that some savings have occurred. But there's a number of avenues in which we can use to try and verify that, and we're very flexible and Ken's become really smart on all the options out there. You can definitely leverage your MERP related assessments, and use those, and then we can just figure out what the compliance path is for verifying that the savings have occurred going forward. With that in mind, it's a little bit of an ad hoc process for starting a loan under this program. It's great to just reach out to Ken before doing the work of an application so that we can, vet the project, understand that there will be that minimum 5% savings, however we want to document that, and then move on more formally once we've sort of done that initial screening. Less relevant now because of the changes of the IRA, but we do have, to the extent there is a tax credit project involved, we do have a relationship with Clifton CLA, a national auditor, to help with the tax filings required to receive that rebate. Although that'll be, for the most part, being phased out by the end of the year. What is I'll stick with this one. What's not on here, notably, as compared to some other programs, are Build America, Buy America requirements, as well as wage requirements associated with the project. So those are two great advantages of this program as compared to some others, and should hopefully result in some cost savings from that alone. What we do need to do is, and this will be reflected on the term sheet on the subsequent page, is a fairly light touch environmental review. Our source of capitalization for this program requires that. And for the most part, to date, our projects have been categorically exempt from any further environmental review. And generally, we think that will be the case because we're really talking about small modifications to existing buildings, equipment, things like this. So yeah, just as a heads up, that's a screen, and it hasn't been very onerous for most of it. We have a consultant to do that, and it's very low cost. Yeah, Jackie, question there.
Yeah, so the project that we're looking at using this loan for is is a bridge for the investment tax credit for a small hydro project, which is being
Hmm.
funded through FEMA, USDA, and we've had to go through FERC approval. So
Hmm.
having already cleared all of those bars, would you accept the environmental reviews that have already been conducted, as well as benefit cost analysis and everything that we've already sort of had to thread the needle on with all of those federal agencies?
Yeah, we'll need to do diligence in reviewing those. Yeah, we're not going to do
Okay,
another
great.
review. It would just be a matter of reviewing those to make sure they meet our requirements. But yeah, it would just be a matter of reviewing all the work you've already done.
And we have done extensive work, so we appreciate not
Yeah.
having to do additional work.
Yeah,
Thank
and
you.
that's a good point, right? Like for those that are more complicated that are not categorically exempt, then yeah, we can piggyback on existing work. Okay, so that's the general overview of the program. To the more specifics amount, we have, I'll just kind of go down the term sheet here. We have quite a bit of capacity under this program. Yeah. So reach out as the projects develop. One restriction of our source of capitalization is that the loans can be no longer than 10 years, which is, a little bit disappointing. But for equipment, this actually works out quite nicely. For bridge lending, like was just mentioned, that also works out nicely. One thing that we can do is we can create a blended structure, which we're looking at right now, where we do part of the loan with our conventional pool loan program and part of the loan with this program to lower the sort of aggregate rate. And we're working through the details of that. And for bigger projects, longer lived projects, that's definitely an option. Like I mentioned, the environmental review costs we passed through, those honestly have been in the hundreds of dollars, not thousands of dollars. So this is a little bit of a generous estimate on that cost. The payments do occur monthly. So that's a little bit different from some of our other programs, and we can give you a little bit of lead time in terms of a month or two after closing to start those, but the payments will be both principal and interest monthly. The We fully fund the loan at closing. So let's say you're going to borrow $1 million, you're going to pay interest on that $1 million after closing. Draws on the loan are done by requisition to the bond bank. Can prepay it at any time with no penalty. That's an advantage and helpful for the bridge loans. If you're not exactly sure when the credit will come in or the grant payment will come in. So that's very helpful and also kind of a difference from some of our other programs. Certified requisition, like I talked about. Then the security. We have a lot of flexibility here under this program. A lot of loans historically with the bond bank are general obligations of the town. They can be revenue bonds if it's associated with a utility. And then also we have done some what are called special financing arrangements, I believe, under statute. And this is things that effectively are equipment lease structures. We can do that under this program and have done so in one loan already and soon to be two. Like all of our programs, we need an opinion of local bond counsel that it's you know a bona fide bond or note or financing arrangement, so to speak. We talked a little bit about environmental review. The one nuance is if it is a property that is eligible to be on the National Historic Register, then it would be subject to further review. You can certify that as to us. We're not going to do our own, we're not working with the his State Historic Preservation Office to review each project. We ask you for a certification as to its eligibility, and then to the extent there's a positive certification, we'll do more diligence. But that is a requirement. To the extent we need to, you don't have deemed savings, we do need quarterly reporting on the project. So this could be the report of your performance guarantee. It could be the energy bills, or something of the like, so that we can have that verification process. That won't be, forever for the life of the loan. That's really through the sort of post-installation period. And we do require annual submission of financial report, which is consistent with all of our programs. And then, if the program or if the improvement is not performing as expected, we do have covenants to, do some work to make sure it does start to perform. And I think that's in both of our interests, so that we can sort of validate the savings that we're producing as a result of the program. And then, like all of our programs, we do a credit underwriting process. It's approved by the board. We have board meetings biannually. So, if you're the longest you're going to wait for a decision is about 2 months, but oftentimes it's shorter than that. And oftentimes we're talking to people over several months to sort of validate the project and get all the details we need. Give Ken an opportunity. Anything, tricks of the trade here after reviewing a few of these, Ken?
No, I think you covered things pretty well. Just to clarify, yeah, so our board meets basically every other month. And so, if we get an application in, the week before that board meeting, that's, we're not going to be able to get approval then. But if we get an application, ideally, we're already talking with you. You've already reached out and said, "Hey, we're interested in this program," and you've provided me with some energy savings, cost savings, information to sort of to verify eligibility in that regard. And then, if we get the application, say, a month or so before a board meeting, then, it's a good chance we'll be able to get the credit review done and get it in for that meeting. So yeah, and it's a typical credit review. We look at operating ratios and debt service ratios and those kinds of things. Yeah, I can always happy to have a specific conversation with you about debt capacity, those kinds of things for this program or generally.
Okay, last piece of this discussion is an example. We've kind of used this example probably more times than is appropriate, but I do like it because it shows how different sources can come together. So the Charlotte Town Garage, their prior garage had burned down. We used our pooled loan program to help rebuild the structure, and then used this program to help finance the solar array that went on top of the building. In addition to our sources, there were some other grant sources as well that went into the project, and just shows how kind of the bond bank's different programs can be used together to, complete a project that may not be in its own right entirely about energy, but it might have some accompanying pieces that are eligible for this particular program that bring the overall cost down. So that's what we have on the energy program. Any questions from the audience? Okay, terrific. I should also mention, in fairness to them, there's a very small. The notice just went out yesterday from DPS or yeah, DPS at the state, who has finally worked through some agreements with the Department of Energy, and I think they're actually both with the Department of Energy to create what's called the Municipal Energy Revolving Loan Fund for energy related projects. It's only a little over $1 million in total that's available, but it is the initial interest rate will be 0%. Up to $250,000 is excluded from the Build America Buy America requirements, although it does have Davis-Bacon requirements. So they are actively soliciting projects between $100,000 and $250,000, more or less. Those loans will be with the bond bank, where we're going to be acting as a fiduciary for the program. So that's another option that's out there as well, and that notice just went out yesterday. Okay, why don't we switch to housing? Oh, wait, sorry, one more slide. Application, just to reiterate, reach out to Ken first to vet the savings of the project and documenting that savings, and then we'll once we sort of check the box on that, then you can apply. We have a omnibus application now. All of our programs are in one spot, and so you're just going to be selecting the energy efficiency and renewable energy program as your specific application type in the application, and that's available up on our website at the top. Okay, so now moving on to housing. This is a fun discussion because only last Thursday did we close our first loan under this program, which is shown in the bottom left, the Stevens Branch Apartments in City of Barry, who we worked with on our pilot loan for this program. So, the point of this program, the Housing Infrastructure Loan Program, is to drive down the cost of infrastructure to reduce costs or create more debt capacity for the project through a lower interest rate. It is agnostic as to the sort of source of funds that you're using for the financing. The Barry example was a existing TIF district. We expect that once the CHIP applications start moving through VEPC, we'll see some of those as well. But it could just be standalone. It could be something that some type of infrastructure that the city or town is considering to support housing development. It doesn't tie to a specific program. It's agnostic in that regard. So the whole point is that the not to miss this. The whole point is that it's some infrastructure costs that, if undertaken, will allow housing development to occur. So that's the sort of binary review that needs to occur. Uses of the funds can be for engineering and planning, construction drawings, the improvements themselves, and the purchase or conveyance of eligible improvements. And what that is really getting at is there could be some cases, particularly in a CHIP scenario, where the developer is building the infrastructure and then conveying it over to the town or the municipality, and that sort of contemplates that situation. Eligible infrastructure in the program is improvements to municipally owned water and wastewater system. The second bullet is really around any kind of transportation type improvements, and then improvements that support those two above primary uses of funds. So the Barry example, there was a drainage line, a water line, and sidewalk improvements that were part of the project. But there was also accompanying environmental site remediation, some GMP utility undergrounding, and that sort of rounded out the total uses, as well as, it wasn't just the hard cost, it was also the soft cost, so total project costs. So just to drive this home a little bit, and this is really with an eye towards chip projects, what are the benefits of this program? Like I mentioned, the lower rate is going to provide more debt capacity than would otherwise be available at the same cost. It's also very flexible, so we are expecting Senate Bill 328 to pass. It is very close to going to the governor for signing, and that creates a new type of revenue bond that is very common in other states, but it will be new to Vermont, which is a special assessment revenue bond, where a special assessment can be the sole security for a bond issuance with governing body approval only, not the general approval of all voters. And so that is a helpful and new form of financing, but one that would not be able to be purchased into our conventional program. But with the HILP program, we can purchase that. So it has a lot of flexibility, whereas our other programs aren't quite as flexible. So here's an example of the extra debt capacity that the HILP program can help provide. So just for example, this is a chip type scenario. We have an estimated project value of $5 million. We're assuming an aggregate 2% tax rate combining municipal and education fund. That's $100,000 of stabilized increment. The chip term is 20 years. And so under CHIP, you have a couple different options. You could have a private developer sponsor, you could have the municipality sort of undertake the project, and this is how this sort of plays out. Under HILP, the total debt service that could support that $100,000 is about $1.5 million. Our conventional program, which is also a very good rate, is also advantageous, but only $1.3 million. And then in the case of a private developer sponsor, they are going to have a higher cost of capital, and oftentimes that underwriting for the increment is going to be subject to debt service coverage requirements on the aggregate loan amount. So therefore, you get to just under a little under $1 million of related debt capacity from the increment. So there's a decent amount of additional capacity that comes along with this program as a result of the lower rate. So another way of thinking about this is that you would have to come up with a grant funding to get to the same amount of infrastructure that you finance between say $150,000 and $400,000 if it wasn't for the very low interest rate on this program. So I'll go over some of the terms now. So the main thing is here that like all bond bank programs, the borrowers have to be units of government, cities, towns, villages, and various districts. For this program, like all of our programs, you have to have a legal opinion from local bond counsel. In applying, we look for 3 years of financial reports, and then the term of the financing may not exceed the useful life of the assets financed. We're setting a target amount of $3.5 million for applications. What the point of the program is to create units of housing. So if there's an extraordinary case where the infrastructure will create a large amount of both direct and indirect units, then that, we'll consider changing that amount. The term can be up to 30 years. The idea here is that if you have say a CHIP program or a TIF program, we can leverage some of that municipal only increment after you lose access to the educational increment and squeeze out a little bit more debt capacity from the project. There's a higher interest rate associated with that given the longer term. Some upfront costs to pay for our disbursement process, basically. Semi-annual payments. It's fully funded at closing, so not unlike the other program. If you're borrowing $1 million, you're going to pay the full interest on that $1 million after closing, requisition the funds from the bond bank. They can be prepaid at any time. We'll just, recycle the money into new programs, general obligation or revenue bond. Local bond counsel opinion, I said that. We do want evidence of, your local permitting and approvals, but we aren't going to perform an independent review of that. Because the program is specifically designed for housing production, we will want quarterly reporting on the progress of the vertical construction, the units you expect to occur as a result of the infrastructure. And so we will be asking questions about that on an ongoing basis. And then like all programs, it's subject to credit review. So your application is two parts in this case. You can submit the application using our Omnibus application, housing infrastructure program, and then after you complete that, we will send you a supplemental application that gets into some of the more programmatic details. How many direct housing units are expected to be created? How many indirect housing units might be created? The cost of the units associated with the vertical housing or with the housing development, the timeline for those housing units or that housing development to occur. And then this is kind of what we need to speak to the programmatic elements. This program was created as a result of a grant from the state of Vermont through the Department of Housing and Community Development. And so this provides us the information we need to then report back up to them on the progress of the program in the hopes that if we're really successful here, we can go back to the legislature and perhaps even ask for more money. We, are still new with this program, so we haven't had a situation where we're reviewing two competing applications, but we have established some criteria for how tiebreakers might occur if we receive applications for more than the money that we have available. Some of these are binary that will, you've got to show housing production, additional capacity and infrastructure that leads to housing development. But some are more something that can be scored. Are you in a designated growth area? Is the project ready to go? Is it in a community that has a lower, or I guess higher Vermont Community Index score in terms of capacity? So we'll privilege communities with lower capacity over communities with higher capacity. And how does the housing relate to the overall state housing goals? Again, we haven't had a situation where we need to employ these, but this is how we would sort of tie break things. We will review applications into this program quarterly. And then your commitment lasts for 6 months. So you have 6 months between the approval date and closing. Otherwise, we will consider other potential projects. Um, I didn't put this in the slides, but one thing to note is that we are working right now to leverage the grant we got from the state of Vermont. And increase the overall capacity of the program. But we're probably going to top out somewhere around $20 million or so. Obviously, the grant money is very easy to get out the door, but yeah, at some point we'll reach a capacity. But I think we got a long ways to go in between now and then. So that's an overview of the Housing Infrastructure Loan Program. We could entertain questions now, if there are any. There's a question in the chat. Will you be putting these slides on your website? Yes, we will put this on the website. Also recording this and provide a link to the YouTube. Okay, well, we are at a tidy half an hour here on this presentation. So now you know the details of the two programs. You also, of course, know how to reach us. We are pretty excited about both of these, so we're definitely willing to talk, even if it's just something you're thinking about. Kind of what's a little bit different in these two programs is getting us involved earlier rather than later is really helpful. The Our pooled loan program or conventional program, oftentimes, the bond votes occurred, the project's sort of designed, and we're at the tail end. With the programmatic requirements of these, it's important for us to be involved sooner rather than later. So, yeah, so reach out. With that, I will say goodbye and thanks everybody for making time today. Take care.